Hello, and today is August the 25th, and we're recording this on Friday after the market closed, while the impressions of Powell speaking at Jackson Hole are still fresh in our mind. So, Andy, you give me your take, and then I'll give you mine.
So, I was expecting some discussion on what was priced in terms of cuts in 2 years over the next in 2024, and he didn't explicitly address that. He didn't explicitly. I didn't expect him to suggest he was going to hike in the short term much. That they're close to terminal rate, so that didn't surprise me. That was what we got. But I did expect a little bit more hawkish on the 2024 cuts. So I thought it was a little more dovish than my expectations, but still very clearly higher for longer.
Yeah, no, I actually, funnily enough, agree with that. I've been saying for a couple of weeks that I think what he's going to try and do is lower market expectations of when the cuts are going to start and how deep they're going to be once they get going. And I think he's achieved that. He's basically saying that they're data dependent, and the data is showing that the economy is still very strong. We saw this week the Atlanta Fed GDP now go up to 5.9% on GDP. Now, whether that is broken or not, as some people say, we don't know. But even if real growth is 3% or 4% for the quarter, that is far higher than the Fed is expecting. And after all the data we've had this week, the unemployment numbers, everything continues to be as expected or slightly stronger. And he did stress that he expected the unemployment to moderate further, but it's not happening at the moment. So while that is the background, I think that he basically got it right. He said they're very data dependent. They don't know how much further they have to go. There is a danger that they have to go higher still. But what he stressed and continues to stress was that they would rather err on the side of being too hawkish and not cutting soon enough rather than cutting too soon.
Right.
And the market response, I thought, was measured and correct. The 2 year note started going up in yield. The SOFA 2024s and 2025 started going up in yield. So the market has got the message. The cuts are going to come later and they're going to be slower than what is priced in.
Right. That's certainly the message that we've expected. And it seems with a 20 basis point increase in 2 year note yields over the course of the last, call it 5 or 6 days, the market is beginning to come around to that view as well.
Yes, absolutely. I don't think it goes very far because we do have a lot of data next week and NFP and then CPI the week after, or is it the 2 weeks after that? But what I think is going to happen is that this pressure is going to be continuous. It's going to be a drip until we start getting numbers which suggest that the economy is slowing. And they're nowhere on the horizon. And therefore, I think that it's going to be slow drip. But on the other hand, I think it's very unlikely that the market starts pricing in anything more than a 60 or a 70% chance of a hike in September or in November. So it's the move up in yield is not going to be very pronounced, but it's going to be constant. Every time the market rallies a little bit, it's going to get hit back. It's going to be basically more of the same.
Right. Yeah, I was thinking 5.25 on the 2 year by, call it the FOMC meeting, when we get the new dot plot and they can either, extremely clearly guide us to how many cuts they expect in 2024 given the new data, or guide us to something else, but we'll see then. And I think we drip higher in yields on the 2 year.
And otherwise, what do you think is going to happen next week?
Right. So for next week, it's a for the week before Labor Day, when liquidity is near its lows. It's quite an action-packed week. It starts out with 127 billion of treasury issuance, which is a lot, all in the twos, fives, and 7-year sector, and then moves on to some backward looking data by and large, but important data nonetheless, because it is about jobs, and jobs are the thing that is keeping the Fed on a path to higher for longer, with jolts, ADP, and then the non-farm payroll on Friday. And interspersed amongst that is PCE, which is the measure of inflation that the Fed focuses on in particular. So it's quite a bit of data and quite a bit of supply.
Yeah, no, I agree with you. We should continue to mention that the supply over the coming months in the bond market is going to be astronomical. And therefore, and that's not mentioning what is going to come from the corporates, because they've got a busy calendar as well. They're going to be issuing a lot of duration. Who knows what the banks are going to be doing with their duration, whether they're going to be having to lower their duration when the new regulations come in. So it's the odds of a rally in bond markets, in bond prices, and therefore lower bond yields without the economy cratering or showing a lot of weakness are almost non existent,
Yeah.
because the supply is constant, the higher for longer is constant, the negative carry is constant. There is absolutely no chance, I think, or very little chance of anything but a slow drip higher in yields, which I think is going to continue to pressure equities.
Right. What'd you think of the equity action with everyone waiting all month for the NVIDIA earnings? And frankly, they came in amazingly strong, like really pretty amazingly strong.
Yeah,
And the stock rallied 11% in the after hours.
the I calculated that the implied volatility for the 1 day option was around 11%, and they went up exactly 11% and closed unchanged.
Right.
So it was a wonderful opportunity for the market makers to collect some premium. Really, what happened in equities this week? Well, they closed what, less than around 0.5% up. I mean, nothing stronger than that. We were a lot higher. We got squeezed. And then what happened is that the market just fell apart on Thursday. From the open, there was nothing but sellers. And I think that is very indicative of a market which cannot go higher because bond yields are constantly pressuring the multiples. Every squeeze is getting sold. And what is very telling to me is that every market on close is 1 billion, 2 billion, 3 billion to go. And it's real cash. So I feel that at these levels, people who are buying are getting distributed into by the big boys who are reducing their exposure. And I think that is going to continue. I just can't see any hope that equities are going to go higher and stay higher. What do you think, Andy?
Yeah, that pretty much lays out what my views are, which is in order to ultimately kill inflation, equities, bonds have to fall in price. And right now, the supply and all of the things you mentioned regarding the economy and the path of the Fed to higher for longer is consistent with a market that's going to struggle to rally, and one in which owning cash is extremely attractive.
So, what do you think we should do with the portfolio? I have absolutely no desire to buy anything as yet. I think we have several more months of bleeding to do.
Yeah, I agree. We're at minimum equities, so that's easy. We're not going to buy, we're not going to sell. And that brings up the idea of, how low do we think the market could go? And the answer is a few percent to start, and then we'll see if what occurs in the weeks to come. But more than likely, if we do test that sort of low end of the trading range we've been in for the summer a third time, that the third time will not hold. And then you could get 3, 4, 5% more. So it makes it difficult to sell puts to acquire stock in a dip, because you don't want to sell puts at that such a high strike that if we test the lows again, then you buy stuff right as the market falls. And you can't sell down 4 or 5% because you don't get enough premium.
Yeah,
So I think we wait.
you're quite right. Volatility is still low. I'm waiting for volatility to give me a signal of when the market will break. It's not giving it yet. October is the traditional time when we have a nice little panic. We might have to wait for that. Who knows?
Yep. Okay, well, I think we have a plan. We're very well defensively set up for exactly this environment. And I think we leave it at that.
Absolutely. Have a wonderful summer.
You as well.
Bye. Here you can see all the allocations. We are at the minimum in equities and not far away from what we consider to be a reasonable minimum in bonds as well. Nothing was done last week as we had no orders, and there are no orders this week either. As you will see in the order entry tab, the broker statements are updated and you can download them and have a look at exactly what our positions are. At this stage, I would like just to have a brief couple of words as to why we're doing nothing. We're not being lazy. We are just recognizing this reality. This is a monthly chart, and we use monthly or weekly charts because we are long-term investors, right? And this is a monthly chart of the 10-year note. As you can see, this is likely to be the highest close of a month that we've had, well, since basically 4 or 5 years. And we think that we are likely, with all the supply that is going to come in the next few months, get to about here, to about the 458 level, before this move in the bond market in 10s and 30s, and this is a monthly chart of 30s. So we think that the 30s are likely to get to the top here around 470. So until these moves are played out and the bonds can stabilize and therefore equities can stabilize and their multiples are not being pressured, we think it's very wise to stay at the minimum allocation in both bonds and in equities. As soon as we've reached these levels in 10s and 30s, that is when the market can stabilize and stocks can do better and bonds can do better, unless it's a big risk-off move, and that's because the bonds have got to a yield that breaks equities. But that is not a decision we need to make now. That is something that we can decide in a couple of months' time, or maybe less than that, who knows. But if the market gets to around 470 in 30s and to around 458, 59 in 10s, that is where we want to start building a long bond position and possibly a much longer equity position. So we're not being lazy. We are just being good long-term investors, waiting for the move to play out and waiting for an opportunity to put on long-term positions which are going to be profitable in the medium to long term.